Just give a quick moment for everyone to join in. All right, good afternoon, everyone. Thank you all for joining us on today's webinar. We'll be discussing the practice steps your healthcare organization can take for managing your provider relief fund distributions. Aaron Cohen, Principal and Healthcare Co-Practice Leader with Citron Cooperman, will kick off today's discussion. Aaron?
Thank you very much, and welcome everybody to the webinar. The goal today is really to spend time talking about ways to manage your provider relief funds. I know there's been a lot of information that's been provided in the past about the timing and the amounts of the provider relief funds, but now that most of them have been received at this point, our focus is on the key issues related to ensuring the appropriate usage of those funds to ensure that you're in a good position later on as HHS starts to take a look and to determine whether the funds were used appropriately and begins to do some of its audits, which we expect will take place through the OIG. So in terms of our agenda today, we're going to give a brief overview of the provider relief funds. We'll then spend some time talking about managing provider relief funds, the eligibility for the funds versus the fund usage, and how to think about the usage of the provider relief funds through a risk management spectrum. And then some of our suggestions for tracking, documentation, and reporting of the provider relief funds. And then we're going to spend a little bit of time at the end also speaking to tax and audit considerations associated with the provider relief funds, and some sector-specific considerations for post-acute care providers and dentists. I'm going to now pass it over to my colleague, Kate Broderick, who is going to give some of the basic sort of overview of the provider relief funds, and we'll go from there.
Thanks, Aaron. So just to kind of go over what the provider relief fund is at a high level, the provider relief fund was created through the CARES Act to provide financial support to healthcare providers. These funds are subject to fairly significant terms and conditions. We're not going to enumerate all of them right here, but critically, the funds are to be used to prevent, prepare for, and respond to coronavirus. Additionally, they can only be used to reimburse providers for healthcare-related expenses and lost revenues that are attributable to coronavirus. Finally, the funds are not considered a loan, they're a grant. However, providers may face recoupment if they can't substantiate that their lost revenues and increased expenses attributable to coronavirus were equal to or greater than the amount of the provider relief funding received. Additionally, providers may face recoupment if they cannot substantiate that they were in compliance with the terms and conditions. One key question that's been floating around this money, which we'll discuss a little bit more later, is how long providers have to use this money. Based on information issued this week, again, we'll go into greater depth on this later, it appears that providers have until next July, at which point they would have to submit a final report to use these monies. So Tracy, if you can go to the next slide. So again, just a little bit more detail on these funds. There have been several allocations. They started in April with the general allocation. That was $50 billion. And that was primarily focused on Medicare providers. Since then, there have been a number of targeted allocations. So those were subject to application, in various forms, and really trying to target providers that have been most impacted by the COVID crisis. To date, about $116 billion has either been obligated or distributed. There's $175 billion in the entire fund. From what we're hearing right now, Congress goes on recess in early August. There's buzz that they are trying to get another kind of CARES 4 out before that time, which may include additional funding for providers. But to date, these are the distributions that have been announced. Tracy, the next slide. And this is just a little bit more detail on those targeted allocations. The first four, the high impact distribution to hospitals, safety net hospitals, the rural distribution, skilled nursing facilities, those were primarily done automatically based on things like cost reports or where the facility was located. Some required some degree of application. Those at present are closed. The three at the bottom, Medicaid CHIP providers, dental providers, and the uninsured relief fund are ongoing. Medicaid and CHIP and dental have until August 3rd to apply. And the expectation is that those distributions will be rolling as the applications are approved. And then the uninsured relief fund is also ongoing. And that allows for providers to get reimbursement at Medicare rates for COVID care. So that's where the patient has a primary diagnosis of COVID-19, unless the patient is pregnant, in which case the COVID diagnosis can be secondary. Next slide. All right, and I'm going to hand it back to Erin to go into greater depth on managing provider relief funds.
Okay, great. So from our perspective, there are really 5 steps in appropriately managing provider relief funds. And we're going to go through all 5 of those right now. So the first of that, the first step is really determining your eligibility to have received the funds, reviewing the terms and conditions, certifying eligibility, and documenting the receipt of the funds. Second step is critical, which is risk management, crafting internal controls and determining the allowability of fund usage. As a third step, what we're referring to as cost accounting. It's really establishing appropriate accounting procedures to track the funds received as well as their usage, and making sure that at a later point, if there is a question as to how the funds were used and the appropriateness of that usage, that you have the appropriate procedures to be able to walk through, if questioned. And then there's deployment and documentation, allocating the funds to specific uses and documenting the use. And then the fifth is the reporting, standing up and testing reporting capabilities. And with the reporting, initially HHS had indicated that reporting was going to be required by July 10th for the second quarter of 2020, the receipt and use of funds for that quarter. That was delayed, and there has been no official reporting requirement at this point. But a notice was just published in the last few days by HHS indicating that there would be reporting that is required, and that reporting would be due into the very beginning part of 2021, and that there would be far more detail that was provided in August regarding that reporting. So nice to get some further information on that recently, and there's more to come. Tracy, if you go to the next slide. Okay, so this really goes through, and I'm not going to belabor this. These are the key eligibility terms for receiving the provider relief funds. And really, the key ones here, if you look at the eligibility certifications, in the third row below, the recipient needs to certify that it provides or provided after January 31st of this year diagnosis, testing, or care for individuals with possible or actual cases of COVID-19. Possible cases has been interpreted very broadly to include basically any patient. So really the question is, has the provider provided services after January 31st, 2020? If the answer is yes, the recipient will use the payment to prevent, prepare for, and respond to coronavirus, and payment shall reimburse the recipient only for healthcare related expenses or lost revenues that are attributable to coronavirus, as well as some other terms and conditions that have been set forth by HHS, including some restrictions on balanced billing. At that point, a provider can feel comfortable that they were eligible to receive the funds. So that piece of it, eligibility, is pretty straightforward, and we think that most providers are going to be eligible. The key is going to be what the funds can actually be used for, and that's what we're going to get into next. If you go to the next slide. Here we really talk to the difference between eligibility to retain the funds versus the eligible fund uses. And as set forth below, you can see that there are really two primary uses for eligible funds. It's to prevent, prepare for, or respond to coronavirus, and the payment shall either reimburse the recipient for healthcare related expenses or lost revenues attributable to coronavirus. The sort of easier to understand category really is the expenses attributable to coronavirus. So HHS has set forth what some of those supplies would be, and it's probably what you would expect. It's those extra costs that you've incurred as a provider to be able to protect patients that are coming in, protect your employees for providing care in the day of coronavirus. So it's PPE, additional workforce training, some of the work to keep the space clean. It's specific costs associated with preparing, responding to, and preventing coronavirus. The more complicated one or area of potential allocation of the provider relief funds has been lost revenue attributable to coronavirus. So the real question has been, what does that really mean? So any revenue that a provider lost due to coronavirus is eligible, including losses associated with lower visit volume, canceled elective procedures, or increased uncompensated care. And providers can use provider relief fund payments to cover any costs that lost revenue otherwise would have covered, so long as that cost prevents, prepares for, or responds to coronavirus, and it's not reimbursed by another source. So one of the key issues is to make sure here that you're taking into account the other funds that have been received, and that the provider relief funds are not being used to cover something that has already been covered by another form of funding from the CARES Act. And these costs do not need to be specific to providing care for possible or actual coronavirus patients. However, the lost revenue covered by the Provider Relief Fund must have been lost due to coronavirus. And so really what HHS has set forth is that if there was a period of time where you've lost revenue, and it's really because of the pandemic, the question is, were those costs such that were there costs during that period of time that were needed really to continue to have capacity to see patients? And were you at a point in time where those relief funds really needed to be used to pay for those costs to be able to stay open? And as I'll go into in the next slide, that's a really complicated overall concept to apply without sort of looking at the risk of different situations to determine when there is that need for these funds to be used for expenses to allow for that capacity to stay open. So if you go to the next slide, Tracy. This sets forth our perspective that when it comes to the provider relief funds, it's really a question of risk, and that from our perspective, without more sufficient guidance from HHS in terms of the precise usage of the provider relief funds, that we think that for all providers that they need to look at a risk continuum of where the funds could be allocated and used, and really determine where they feel like there's where there's comfort around the use, looking at it again through the perspective of risk. So we've divided the different uses into three different real strata of risk: low risk, medium risk, and higher risk. And even for these items that are higher risk, we want to note that it's not 100% clear with the guidance that's been given. These are necessarily not appropriate uses, but we believe that they're much higher risk. Whereas some of these low risk items, it may also be the case that it's not 100% under the guidance that they're going to be acceptable uses. But we think that there's a very strong argument, and that it would be surprising to us if they were not acceptable. So if you look at the low risk area, we really speak to two different items. So the first is healthcare related expenses. So expenses incurred at higher levels due to either increased volume or increased costs. And these are expenses that clearly help to prevent, prepare for, or respond to COVID-19. So things like additional PPE, purchased at higher rates, and extra cleaning and sanitizing services, technology purchased to enable telehealth, additional workforce training, staffing and unplanned overtime, modifications to the facility to improve infection control, items like that. We think that there's going to be a very strong argument that the money can be used to reimburse for those expenses. And one thing that I should make sure to note right now is that we do think that if you had an expense like this going back into March and April, and you received funds in May, you are able to go backwards and allocate those funds to those costs, and to note that those costs are related to additional healthcare related expenses. Additionally, in low risk, one of the items that I discussed before is that when it comes to lost revenue, we think that in a month where you have revenue losses such that the monthly expenses exceeded your monthly revenues, that the expenses that you incurred to stay open during that period of time that we do think that there's a very strong argument that you can allocate the funds to those expenses, because frankly, this is money that's allowing you to have stayed open during that period of time and to maintain delivery capacity. So employee payroll, rent and mortgage expenses, equipment leases, electronic health record licensing fees. These are, examples of those sorts of expenses during a month where you have had expenses in excess of revenue. In terms of medium risk, it's really those expenses that you typically incur, but that you've now incurred at a higher than normal level. So HHS hasn't listed these items specifically, but it does seem that if you generally spend $1,000 for a certain type of supply, but now you've had to incur $2,500, and that's clearly greater than what was budgeted and higher than what you typically would have incurred. And the real strong argument for why that's been the case is because of coronavirus and to prepare, prevent, and respond to coronavirus. We think there's a pretty good argument that you should be able to look at those items and allocate the provider relief funds there as well. And then on the higher risk side, here we really, have healthcare related expenses for those items that really were items that you likely would have incurred anyways without coronavirus. We think that applying the provider relief funds to those types of expenses is probably a tougher argument. And then the other issue is with the lost revenue. If you have lost revenue during a month where your expenses do not exceed monthly revenues, and really the application of the provider relief funds for expenses during that month, there's a real question of whether it really helps you to maintain capacity, because what it's really doing is helping to support profitability and lost profitability. And without more guidance from HHS, our perspective is that that's higher risk at this point, because it's a tougher argument with the diminished capacity. So that's pretty quickly walking through the different layers of risk and how we see this playing out right now. And I'm now going to pass it back to Kate to talk about some of the documentation recommendations that we would have with the provider relief funds.
Thanks, Aaron. So what we've done is to go through the terms and conditions as well as the applications and kind of pull together our thoughts on what sort of documentation providers should be thinking about compiling, organizing, making sure they're readily accessible. There's really two goals for documentation. One is the documentation of the receipt and use for the funds, and the second is the documentation of your eligibility to have received the funds. So we'll start first on this slide with receipt and use. So at a high level, providers need to be able to substantiate their responsible stewardship of the funds and be able to provide transparency in their management of the funds. So, again, not going to belabor this, but at a high level, providers need to be able to maintain records of the amounts of funding that were received, bearing in mind that some providers received multiple distributions, and maintaining kind of bank statement level records of the amounts that were deposited. Providers need to put in place proper internal controls of the funds. That's explicitly called out in the terms and conditions. And that's for control of the funds, as well as a process for determining which costs are allowable to be covered under these funds. Providers need documentation of the other funding mechanisms that have been received, such as PPP loans. As Aaron described, there are scenarios under which providers could use this money to cover expenses like payroll and rent, which obviously overlap with the PPP. And because, there can't be effectively double counting of expenses across multiple funding mechanisms, ensuring that you're able to keep clear records of what expenses were allocated where is really critical. Additionally, documentation of lost revenue. In the calculation guidance from HHS, they've provided for any reasonable method of estimating lost revenue, but specifically called out a year-over-year comparison or a comparison to budget. So gathering materials that will substantiate those kind of clearly defined calculations, tax returns, volume metrics, internal financial statements, those types of materials that will allow you to very clearly walk HHS through how you arrived at your calculation. And in documenting the uses, maintaining receipt level detail, providing general ledgers are all going to be really important to substantiate how the money was spent. Additionally, bringing together any line item budgets that you have, those will allow you to do a comparison of what you actually had to spend versus what you would spend in a normal year, or what you were anticipating to spend, on things like PPE, cleaning, et cetera, to really substantiate the increased expenses that are attributable to coronavirus. That will also help you to substantiate the expenses that normally would have been covered by lost revenue. In addition, in the documentation of uses, we feel that it's wise to maintain documentation on how each use helped to prevent, prepare for, or respond to coronavirus. Again, it's not totally clear at this point what HHS will be looking for, but ensuring that you're kind of keeping for yourself the justification for why you spent the money where we anticipate will be helpful, as well as whether you're kind of attributing that use to lost revenue or whether you're attributing it to a healthcare related expense. Tracy, if you could go to the next slide. So this is more of the eligibility documentation, and these dive into the targeted allocations, but of course the general allocation eligibility is important to review as well, though a little bit less complicated. So eligibility, obviously it's going to depend on what distribution or distributions you received. The documentation we've compiled here, again, is based on the applications as well as the terms and conditions. At the moment, it's unclear whether documentation substantiating your eligibility will be part of the reporting requirements. But again, to ensure that you're kind of keeping your records as complete as possible, we feel it's important that you kind of pull together whatever you submitted that substantiated your eligibility, as well as supporting documentation. All right, Tracy, the next slide. So we mentioned this earlier. There was an update on Monday from HHS regarding the reporting, and a couple, it was a little bit vague, but a couple key things did come out. The first being that any providers that received one or more payments exceeding $10,000 in aggregate will be subject to these reporting requirements. In the terms and conditions, it's a little bit unclear, but it did seem like the kind of threshold was going to be higher. At $10,000, it's going to be the majority of people who received anything from the Provider Relief Fund. They are going to be issuing more detailed instructions by August 17th, which hopefully will be helpful in understanding some of these key questions that are still outstanding. The reporting system will be available on October 1st. All recipients must submit a report within 45 days of this year's calendar year end on their expenditures through that period. If you've fully expended your funds by December 31st, you can submit one single and final report. One important thing to bear in mind, while you may not be subject to additional kind of ongoing reporting requirements, in the terms and conditions, providers are required to maintain their documentation for 3 years. So just because you've submitted your final report doesn't mean that you can kind of, shelve all of the documentation. It's important to keep that around in case there's any further scrutiny. If you have not fully expended the funds by December 31st, providers must submit a second and final report no later than July 31st of next year. What that seems to indicate, though it does not explicitly say, is that providers have until next year, presumably somewhere around July, to fully expend the funds. It's been unclear to this point how HHS was looking at the time period, but that seems to provide some clarity. And again, by August 17th, we should have more details. So the next slide, reporting requirements. So again, what HHS issues in the next couple of weeks should provide some additional color on what they're actually looking for. What we've set forth here are the requirements that are in the terms and conditions. And what these requirements really make clear is that providers are going to be responsible for not only tracking the money they receive, but tracking the uses to a very granular level, and really being able to provide complete transparency on where the money was deposited, how it was used, including whether any of those funds went to subcontractors or subgrants, ensuring that there were proper internal controls and that the money was not misappropriated. And the next slide. So one final point to kind of bear in mind on the reporting requirements is fund management in a transaction. HHS has issued some guidance around this, and they've been fairly explicit about a few key points. Number one being, this money is tied to the TIN to which it was distributed. So if you, and this is particularly important for asset purchases. So if you're contemplating an asset purchase, if you've undergone one since this money has been distributed, the money cannot be transferred from a seller to a buyer. It has to stay with the seller. If the seller does not have enough eligible uses of the money, then the balance, whatever is left over, has to go back to HHS. HHS has clarified that it's different under a stock purchase. Under a stock purchase, the money can stay with the entity and the entity can use it. Asset purchase, obviously a different situation. And what also has become clear based on this guidance is that there's really been a risk for newly formed entities. So for those that did not provide care in 2019, they've largely missed out on a lot of the key distributions. And HHS has actually explicitly stated that they do not intend to redistribute funds returned by sellers to buyers, which is obviously a very difficult situation for some buyers that have been left out in the cold despite providing care throughout the crisis. Fortunately, they have said that new entities may be eligible for future distributions, but unfortunately, they've been left out on many. The key thing here is to remember that the money cannot be transferred. A seller cannot accept it on behalf of a buyer, or I'm sorry, a buyer cannot accept it on behalf of a seller. It has to stay with the TIN owner. And with that, I'm going to turn it over to Michael.
Thank you, Kate. Good afternoon, everyone. I'm going to take you through some tax and then some audit attest considerations that you should be thinking about for the upcoming year. So first, let's talk about tax. And obviously, this really applies to those that are taxable entities. But I guess what you've been hearing, or maybe you haven't heard, is that these provider relief funds will be considered taxable income in 2020 up until the point that the funds can be matched against expenses and or lost revenue. As Kate and Aaron has discussed, not only do we have until December 31st, but there's a potential to use these funds in 2021. So if the case that some of these funds are not utilized or accounted for in 2020, then technically those funds would not be considered income till potentially 2021, And if never used, it would just be a liability. So just something to think about. It's similar to the PPP loans, where the PPP loans expenses are not going to be deductible. Here, these grant funds will be taxable. So what does that all mean? Well, for most entities, you probably have paid in enough or will pay in enough in 2020 based on 2019. So the tax liability issue is really going to be April of 2021. So it's very important to consider some tax planning and where you're going to wind up as of 12/31. As I mentioned, if there's a possibility that some of these funds will not be utilized by December 31st, then those will be considered a liability, and you'd only be taxed on the portion that you actually can match. The other important tax consideration is, for many states, now the pass-through companies can take a deduction for state income taxes to its members, shareholders, partners. So you're going to want to work to know what that potential tax liability is, so payments can be made and a deduction can be done in 2020. So there's a lot of things going on with the tax end, but just the note to take away from today is that there is going to be taxation on these amounts. And again, it's all going to be predicated on how your year end works. I mean, obviously these are taxable, but if you're still in a tax loss, then you will not be taxed on it. So just something to consider. Next slide, Tracy. So as we talk about audit and attest considerations, and when I talk attest, that means not just for audits, but there are providers that just have reviews and compilations. This really relates to anybody that files an external set of financial statements to either its board or to a bank or to any other grantor that use an accounting firm like Citrin Cooperman to assist with. So just a couple of things I want to just bring up and discuss. One is the recognition, and we've heard how these funds need to be accounted for, how they need to be matched up. So really the importance is going to be how these funds are actually going to, what their funds are going to be shown up as of 12/31. And as we talked on the tax end, if there's a potential that some of this money that you did receive is not going to be matched to any lost revenue or expenses, and you're going to defer it until 2021, then we potentially have deferred revenue versus any type of versus revenue at the end of the year. The other instance can be, I don't want to talk about it, but if you do close or if there's a sale in 2020, you potentially might have a liability, meaning you don't have any more time to utilize these funds, and you cannot account for them. Then the money that you have potentially would be owed back, and that would be a liability. So there's three scenarios: recognition of this grant fund as income, deferred revenue, or a liability. Now, when it comes to your financial reporting, it really depends on your year end. For most of you, we've been through the 12/31/19 year ends, but there are still some that might exist. So a lot of this information happened, as you know, in 20. So it's all deemed to be a subsequent event in your financial statements, which is basically letting the reader know everything that happened regarding your PPP loans and these provider relief funds. For your June year ends, September year ends, and 12/31/20, the important piece is going to be the recognition, which I mentioned, and then how we're going to disclose this information, especially as it relates to policies. So if you've never had a policy on the recognition of grant funds, that's going to be a policy you're going to need to adopt. You're also going to need to know how these funds are getting recorded and allocated. So that might be an additional reporting. So there's a lot of things that go into this. You're going to need to find out how these funds, if are going to account for and play into any loan covenant calculations. So if it's unclear, you should get clarity from your bank that how these funds, if they are going to be recorded as income, where are they in any of the loan ratio covenant calculations that you might have. So, which might then impact your compliance and require a potential waiver. So there's a lot of things that can happen with this money that you need to look into. The third item I mentioned is a positive, is that these funds are excluded from the single audit requirements, uniform guidance. And for those nonprofit organizations on the call, you might already be subject to uniform guidance, and that these funds are not. But for some of the for-profits, there was a possibility early on that you might be subject to uniform guidance because these were federal awards. So we've got clarification, and those awards are not. Next slide, Tracy. Next slide. So really what I want to go over is just a couple of specific things to post-acute providers. Kate and Aaron did a phenomenal job laying out in slides 9, 10, and 11 what you need to do and how you need to prepare for all this. So I really have those 3 bullets. I'm keeping those in mind: prepare, respond, prevent. You really need to look at not only the slides, but what you're doing. So the real important things are for SNFs, home health, hospices, other post-acute providers, assisted living, is documenting, as Kate talked about, how you are utilizing these funds. Because some of the wording is vague. So we talked about COVID-related expenses. So here, we obviously know that for our facilities and agencies, we have significant amounts of gowns, masks, gloves, shields, other items that we're utilizing when we're coming in contact with patients. So those costs, those incremental costs, all need to be captured. We've talked about cleaning, that facilities are cleaning more, spending more on supplies, spending more on contract services and our employees to actually make sure rooms are clean, hallways, common areas, especially in assisted living and skilled nursing facilities. Those items need to be considered. Nursing homes have done a lot with their restructuring to make sure they can accept visitors, they can accept new residents in rooms that were meant to be for 2 and now for 1. So there's costs that might be up for shields, so for segregating visitors in certain areas. We have tablets and other electronic devices that people are utilizing so their loved ones and others can be in communication. So there's a lot of costs that you're incurring that need to be tracked and identified. And obviously the big thing is obviously staffing, hero pay, whatever you want to call it, overtime, shift differential. You know, for many of you that did receive PPP loans, you do know that we have up to 24 weeks to claim that money. And then you can also claim utilities and rent. So now under the provider relief funds, we have at least until December 31st and then even beyond. So there is time now to really evaluate your payroll and really determine if it needs to go in my PPP bucket or potentially in my provider relief bucket. So with that, you definitely have some more options. And as it comes to lost revenue, I guess the big thing I want to talk about for post-acute is how you're determining what might be eligible for that calculation. As Kate mentioned, there's 2 prescribed methods, the comparing to prior year and comparing to budget. So that means maybe looking at March, April, May, June this year and looking at the same period last year. And I know I hear from many clients that what about PDGM and PDPM? Well, you've got to consider that, and maybe you look at another period of time that makes sense. Maybe you look at October, November, December versus the last year when you're doing comparisons. I know it's hard for the home health because it started, your new payment system started January, so you really had January and February under the new system, but you had a lot of overlap from the old system. So I would do your best, but really considering your census, your occupancy, mix, with the skilled services down due to hospital surgeries being way down for electives, you really should have a significant swing in your revenue, not only with census and occupancy, but just on the mix, because your Medicare, some of your commercial insurances, which pay higher rates for the skilled services, are probably way down. So you really need to look at all these items when you're trying to evaluate your lost revenue. So with that, I'm going to pass it along to Gary, and obviously we'll take questions at the end. Gary?
Thanks, Michael. I'd like to talk a little bit about the dental provider eligibility. HHS intends to distribute the equivalent of 2% of a provider's patient care revenue based on their most recent tax filing to eligible applicants. And in order to apply, providers must meet the following eligibility criteria. You must not have received payment from the initial $50 billion Medicare-focused general distribution, and must not have received payment from the $15 billion Medicaid and CHIP distribution. And then number 3, must have filed an income tax return, either in years 2017, 18, or 19. Must have provided patient dental care after January 31st, 2020, and must not have permanently ceased providing patient dental care directly or indirectly through its included subsidiaries. And the key, if the applicant is an individual, which many of our dental providers are single member LLCs or sole proprietors, you have gross receipts from providing patient dental care reported on Form 1040. And on Schedule C, we use line 1, and we exclude any income reported on a W-2 as a statutory employee. Next slide, please. Now, I'm going to go off script a little. If a dental provider is operating in a different entity, such as a partnership, you would enter line 1C minus line 12 on your Form 1065. Or if you're in a other flow-through type entity, such as an S-Corp, you would use enter line 1C minus line 10 from IRS Form 1120S. So let's dive into the actual application process. Many of my dental clients, and I'm sure people on this webinar, do not have what's called an Optum ID. So the first process would be to apply for one. There is a portal, and I'll give you the address. It's https://cares.linkhealth.com. At that site, you would create a user ID and a password, and then you would have a Optum ID created for you. The next process in the step would to validate your taxpayer ID number. And what happens is that although it's our materials tell you that the process is relatively quick, the last application that I assisted with earlier this week took a 24-hour turnaround period. So don't be alarmed if it's not instantaneous. And HHS is following the use and the source of the funds through your TIN. Once your TIN has been evaluated or validated rather, you're going to go to step 3, where you're going to enter some revenue and tax information in order to move along with your application. And ultimately on step 4, you're going to attest to the payment terms. And I just would like to just dive in for a couple of minutes regarding the actual application. So there will be some information that you're going to need to submit or upload with your application. If any of our participants have applied for and obtained PPP loans, this is similar in that vein. You would file your application and upload required documentation. Some of the documentation, again, would be to include your most recent federal income tax return, whether you're using 17, 18, or 19. They would want your employer's quarterly federal tax return, which is called IRS Form 941 for reporting payroll for the first quarter of 2020. And then they would want the employer's annual federal unemployment tax return on IRS Form 940 for 2019. There is a FTE, or what we call full-time employee calculation worksheet that's obtained from the HHS website. And then you might need to upload a revenue worksheet, but there's specific instances for that, and it's just beyond the scope of this webinar at this point. A couple of key takeaways I would like to mention is when we discuss lost revenues, The lost revenues really are attributable to the months of March and April of 2020. And as Kate had discussed previously, lost revenues due to COVID-19 really means the amount of any patient care revenue lost due to the coronavirus. Now, this may include revenues losses associated with fewer patient visits, canceled elective procedures, or increased bad debts or other causes. So it's a broad term. And the way to evaluate what lost revenue is, you can use any reasonable method, but a year-over-year comparison is acceptable. With respect to increased expenses due to COVID-19, again, the reporting period would be March and April of 2020. And then increased expenses is also a broad term, and it covers a range of items and services, including supplies used to provide healthcare services for possible or actual COVID patients. Really what they're talking about is PPE, which is quite expensive. Any equipment used to provide healthcare services for possible or actual COVID-19 patients, workforce training, and if you had to build or construct any temporary structures or expand capacity for COVID-19 for social distancing, these are all acceptable increased expenses to include in your application. Another thing that is required in the application is your payer mix. So if you provide Medicare or treat Medicare patients, they're going to want to know parts A and B and C. If you provide any Medicaid services, and then they're going to take a look at your commercial insurers and your self-pay. So you're going to need to have this information handy when you're filling out your application. Also, they're going to ask you for any PPP loan that you applied for and were granted. So you'll need to have that information along with banking information, because once funding is approved, they will automatically deposit into your account. And I think that's all the time that I have with respect to the dental providers.
Okay. So we did get a couple questions. We've been trying to answer some of the questions that we've been receiving from attendees throughout, but we did have a couple that we wanted to answer for the group. And of course, if there are any others, feel free to type them out right now. One question that we received was, for organizations that are using the 24-week covered period for their PPP loan versus 8 weeks, can they elect what weeks to apply PPP to in order to maximize periods in which they have revenue losses that could be covered by provider relief funds? Or should the PPP be spread evenly over the 24-week period in terms of determining other sources of funding when doing the provider relief testing? And I wanted to pose that question to Michael.
Thanks, Aaron. So I think the answer is there's very little guidance on that. So my ultimate answer would be, since you've got up to 24 weeks for PPP, we have maybe a year for the provider relief funds. I would do what you need to do to make sure you don't owe any money back. So I don't think you have to be consistent with the weeks. I think obviously, if you're not reporting consistent weeks under the PPP, it might just be more of a challenge when you submit information, if whatever gets submitted, to say, okay, this is my payroll for 12 weeks, but I carved out 2 weeks. But it can be done. I don't see it, because there are many providers that have already received other funding, states from Connecticut and Rhode Island, that are going to have to pull money out. So my feeling is, if you want to take your payroll for 24 weeks and carve out pieces that you think are going to help with the provider relief fund, carve them out. I mean, the worst thing you want is to, at the end of the day, owe money back. So I would be able to do that unless something specifically comes out, but I doubt it.
Can I jump in as well for a moment?
Sure.
With respect to dentists and home health businesses, as well as retail and closed shop pharmacies, what I've experienced in my practice is that with the PPP loan, the 24-week hurdle will make it very easy to meet the eligibility requirements for to have the loan forgiveness. So don't forget, it's not only payroll, but rent under a lease obligation that was in effect as of February 15, 2020, plus employee fringe benefits and health insurance. So at least in my experience, with the expansion from 8 to 24 weeks, that many of my clients are going to easily meet that requirement to maximize loan forgiveness. And then you can then allocate other uses of the funds for the relief fund. So any questions, you should reach out to your accountant or consultant to help you with that. But in my experience with these types of entities, it's going to be a pretty easy hurdle to maximize loan forgiveness and use the funds for the PPP loan pretty quickly.
Yeah, especially now that you can go down to 60% payroll. So that's the other good thing that changed, is that you only have to account for 60% of the PPP for payroll. So that, on top of what Gary just said, I think you should have a lot of room to be able to apply things to the provider relief funds.
Okay, and then we did have one other question that we wanted to make sure to respond to. We got a question, does, quote, employee payroll include doctor/owner payroll, which is a simple question to ask and a much harder question to answer. And so I'm going to pass this over to Kate. And I may actually jump in as well, but let's have Kate respond first, and we'll go from there.
Great. Thanks, Aaron. So at a high level, HHS is encouraging providers to use this funding to maintain their healthcare delivery capacity as a response to coronavirus. It seems pretty reasonable that you need to pay your doctors in order to maintain your healthcare delivery capacity. What becomes complicated here is the issue Aaron discussed earlier about replacing lost revenues versus replacing lost profitability. So if your expense base has been higher than your revenue, it's very clear that you can use the money to cover that delta. What's more complicated, particularly in the situation of physician owners or really any owner, is you had to have produced some level of profit. And if you're using this money to cover lost revenue, despite the fact that your expenses have been covered by your revenue, you get into that issue of lost profitability. So from my perspective, it seemed, the way the provider is paid seems really important. So if it's a W-2 employee and their salary expense is an operating expense, that seems to be lower risk. If they're a K-1 employee and they're paid through dividends, that obviously gets into the higher risk profitability issue. But I'd like to get Aaron's thoughts on it too.
Yeah, there's just so many ways to look at this. One of the things that we've talked about is when you're thinking about whether expenses are greater than revenue, should you even consider looking at somewhat of a fair market value compensation, to doctor owners? Because you may say, all right, well, this shouldn't replace lost profitability, but not all of the salary for a doctor owner is going to be profitability. So, a fair amount of it is going to be kind of your typical clinical, compensation. I think at a high level, our perspective is that, to the extent that you can use the funds for other expenses other than owner compensation, that we think that that's, lower risk, and that really it's on a provider by provider basis, or in terms of whether the amount of risk of allocating, provider relief funds directly to owner payroll. But I would say if you were to try to lower the risk of it, if you were intent on it, that if you were, let's say, a primary care provider and the average compensation is typically around $200,000, and you're in a period of time where you haven't gotten paid at all, there's probably somewhat of a lower risk associated with getting you back up to kind of the typical compensation for that type of specialty. And that anything beyond that, that's really kind of the profit associated with owning the business, that replacing lost profitability is likely at a higher risk.
Aaron, we had another question on that topic. What if the partner owners stopped taking W-2 earnings because they were worried about all their liabilities?
So meaning that during that period of time, that owner didn't get paid at all. Is sort of, I guess,
That's correct.
So, yeah, I mean, I think there it goes back to what I was setting forth, which is that assuming that that doctor was seeing patients and just wasn't getting paid at all, that it seems like there's a lower risk associated with applying the provider relief funds to a payment during that, related to those months. If, again, going back to what we discussed previously, in general, those months that there was a loss during that month, which presumably there would have been if you didn't pay yourself, unless all you've done is just defer it into later months and have a higher amount paid during those months. But if you were in a position where you were actively losing money and not paying yourself, it does seem like a lower risk use to then apply the funds back to that salary that would have been received as a clinician, not the lost profit, but the clinical compensation.
And the one thing I'll add, there is an explicit restriction on using this funding to compensate anyone in excess of $197,000. We received one more question. When we use the total revenue calculation, our payment based on Medicare revenue is higher than under the total provider revenue calculation. Based on that, will we need to pay back the difference between the amount we received under the Medicare revenue calculation and the amount we would have received under total provider revenue calculation? We have incurred lost revenue and costs well above the total payment received, but have not seen clear guidance on how they will treat the payment calculation differences under the two distributions from the $50 billion, which is the general allocation. From what we've seen from HHS, the lost revenue calculation is based on total revenue. It's not carved up as just, what did you lose based on Medicare. So a year over year or comparison to budget calculation of your lost revenues that are attributable to coronavirus. They do not specify your Medicare revenues, losses attributable to coronavirus. In terms of a delta between what you lost plus expenses and what you received, HHS has stipulated that if you received, if you can substantiate your lost revenues plus your expenses attributable to coronavirus were equal to or greater than what you received, then you can keep the money. And so long as you're kind of in compliance with the terms and conditions, it seems reasonable that if you have anything left over in about a year's time, which seems to be the timeline based on the guidance they've issued, then anything left over has to be returned. But it seems reasonable so long as your losses and your expenses have exceeded what you received, that you should be able to retain it and to use it for eligible uses.
One other thing, just real quickly, Kate, I think the question to some degree was also, is there any problem that your Medicare, under the first analysis, you know, that with your Medicare revenue, whether you ended up getting a payment in excess of what you would have gotten just based on 2% of your overall reimbursement for 2019, and whether you might have to return the excess. I think what we've seen in terms of the guidance is that so long as your healthcare related expenses and lost revenue attributable to coronavirus are going to be in excess of the amount received, then you can keep the full amount. There's not going to be any clawback.
That's correct, Aaron. Yep.
Okay, well, thank you, everybody. We really appreciate everybody listening in, and if there are any questions that we can help answer after the webinar, our contact information is on here, and we hope everybody has a great rest of the day and a great rest of the week.